What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. In this week's video, I'm going to start going over stocks. Now, I'm going to pick these stocks based on an article that we updated over at Stocktrades.ca, which highlights our top opportunities for Canadian stocks in 2024. We update these articles a couple of times a year. They are absolutely insane. The amount of information you get absolutely free on those posts. I believe at this point in time, and obviously you could be watching this later on down the line, this might not be true anymore, but about 8 out of the 12, and these are all Canadian stocks, are outperforming the S&P 500 on the year, and 10 out of 12 are outperforming the TSX on the year. The article is completely free. I will leave a link below in the description, and you can go over there and read it. And if you want to sign up for our newsletter, and you could have got this article immediately when it was released, absolutely free, along with a ton of other market commentary we deliver every single Sunday to over 22,000 readers. You can click the link below and sign up for the newsletter. But in this video, I'm going to be picking a couple of stocks on this list, and I'm going to be going more in depth into them because with a YouTube video, I can get a bit more comprehensive, and people, it might answer some questions people who have read the article might still have, and it might provide a lot more insight for you as a watcher. So with that said, let's dive right into two of the opportunities on this list today and dig deep on why I think they are strong options moving forward. So before we start, everybody, as always, like the video, subscribe to the channel, comment down below, let me know what stock you want me to go over next, whether it's on this list or it's just some completely random stock. I take every single comment into consideration. So Agnico Eagle is going to be the first company that I'm going to go over for our top stock list of 2024. So why I love the stock. Essentially, the merger with Kirkland Lake, this was during the pandemic. They merged with Kirkland Lake, which was a company that I owned. It was one of the most notable gold mergers in quite some time, and it has worked out absolutely wonderfully. I mean, Agnico Eagle is one of the most efficient gold producers in the country, and one of the main reasons that I do like this company a lot is that it does have exposure to companies with countries with heavy regulations, which leads to less disruptions. So we saw it not too long ago with primarily the bulk of the news fell on Franco-Nevada because they have a streaming agreement with First Quantum Minerals at Cobre Panama, which is it's a mine in Panama, one of Franco-Nevada's, strongest streaming mines. I think it accounted for around 20% of overall revenue. That got into some turmoil. The mine completely shut down. It's still on care and control. I mean, to put it lightly, it's an absolute mess. And one of the reasons, again, that I like Agnico is, for the most part, they have exposure to, Canada, the United States, Australia. These are very heavy regulated countries. There is highly unlikely to be any sort of major turmoil in terms of, government regulations, in terms of strikes, in terms of anything like that. Terrorist attacks, you never really know. So that is one of the main reasons why I like an operator like Agnico. Now, this probably does come with higher all-in sustaining costs for sure. It's a bit of a trade-off between that, regulatory certainty and, the ability for a company to operate at lower costs. So the strong price of gold is a tailwind for future earnings growth, which is absolutely no doubt. You're going to see when I go over Agnico's valuations, they're a bit crazy from a trailing basis. But again, when you look at trailing basis, especially on a cyclical stock, especially when forward earnings are expected to be so strong, it kind of paints a picture like this company is ridiculously expensive when it's really not. And finally, as I mentioned, despite a huge run up in price, valuations are still very reasonable. We'll talk about that in the valuation section of Agnico, and it as a well-covered growing dividend. So I'm not going to go over the bulk of the article here. Again, you can look at that article over at stocktrades.ca. I'll drop a link back up too. This is a absolute must-read piece. But let's stick to Agnico. We're seeing, a huge surge in price here over the last while. The company over the last 10 years has reported total returns of 305%. This would outperform any major index here in Canada, but the bulk of the performance is coming this year. And why is that? Well, I mean, when we look to a simple chart, it's the price of gold. We can see that, much like an oil producer like Canadian Natural, Suncor, whatever it may be, much like another gold producer, Barrick Gold, Agnico, maybe to a lesser extent Franco-Nevada, the price of gold is going to drive a significant portion of this company's share price returns. I mean, we can look at a 10-year chart of the price of gold. When the price of gold goes up, Agnico has gone up. I mean, when we look, it gets even more prevalent during the COVID pandemic. I mean, we can see here the price of gold sat at $1,476 an ounce. Agnico was around $77. When gold spiked up to $2,000 an ounce, Agnico was as about $110. They almost rose in sync, the price of gold versus the price, of Agnico's shares. And as always, when the price of gold falls, Agnico falls. But when we're looking to the huge surge in gold, we're looking at gold, let's go to early October 2023, we're talking $18 an ounce. Agnico traded around $60. Now we're up, gold is, $2,600 an ounce, and Agnico's at about $113. And this makes absolute perfect sense. I mean, Agnico is a gold miner. When operations stay steady, let's assume operations stay steady, margins stay steady, this company is going to benefit from a rising price in gold. It's absolutely inevitable. So if you're a particular gold bull moving forward, I do believe this is one of the best producers in the country. In fact, I do believe it is the best producer in the country. When we look to the company's overall state, revenues of $9.9 billion, we're looking at long-term debt of $2.5 billion. The company generated trailing 12-month cash flows of $1.8 billion. And to be honest, actually, I would expect that to continue to grow moving forward with the high price of gold. I would not doubt if this company settles in to the point where it could pay off the entirety of its long-term debt with its trailing 12-month cash flows, especially in the current environment we're in, which is something that I really like to see. I mean, just off the top of my head, when we think of a company like, let's say, BCE, they have $39 billion in debt and they generate free cash flows of around $3 billion. So you're looking at, just off the top of my head, a 13-year payback in terms of the ability to eliminate all the debt relative to the free cash flow they generate, which is, it's not a number that you would ever use in any sort of analysis. It's not something you'd ever use. I mean, it's not feasible or nor logical for BCE to want to eliminate all its long-term debt period, but it is a pretty good indicator of the financial health of a company. Now, when we look to operating margins, we're at 29.5%, gross margins of 36%. These are very strong margins in the sector. And when we look to the overall balance sheet, we can see a debt to equity of 0.09. This company utilizes very little debt and is able to grow just purely based on strong operations. We have a current ratio, which effectively takes the company's current assets and compares it to what it owes over the next 12 months. So just off a basic example, Agnico has $1.51 in cash or cash equivalents compared to every dollar in liabilities that it owes over the next year. And when we look to interest coverage ratios, we're looking at just under 12.7, which is very strong. I mean, I would consider a interest coverage ratio of 5 strong. So when we're looking at, nearly 13, that's absolutely excellent overall. Now, when we look to the dividend from a payout ratio standpoint, you're going to see that it's paying out over 100% of earnings. This is going to come down as earnings improve moving forward. This is, I wouldn't be looking at trailing payout ratios moving forward. When we look to the cash flow payout ratio, it's paying out around 48% of free cash flows towards the dividend. So the dividend is very strong. It's a relatively healthy payout. And when we look to dividend growth, it is very steady. Now, you're not going to get the consistent, reliable dividend growth of, say, I don't know, let's say a company like Toromont Industries, let's say a company like Fortis, Canadian Utilities, things like that, because earnings are very volatile in this sector. The price of gold can dip. The company can lay out a ton of capital expenditures, let's say for a new mine expansion, shutdown, turnaround activity, things like that. So the dividend is not going to be relatively consistent from a growth basis. You might get a lot of years where the dividend is growing very steadily, and then, they decide that, for a few years they don't want to grow it much at all, or maybe cash flows are very strong one year and they decide to issue a huge special dividend. Don't expect any sort of reliable dividend growth from the mining sector, but when we look to the overall dividend, I mean, back in 2014, this company paid 9 cents a share, and we on a quarterly basis, and we fast forward till now, they're paying pretty much 55 cents a share. So great dividend growth from Agnico. When we look to overall valuation, as I mentioned, the company is really not that expensive despite its huge run up in share price. We look at forward expected earnings of 20x. So right now, again, they're trading at 68x trailing. This is not a very good barometer of valuation whatsoever. Earnings are accelerating as the price of gold is accelerating. And the one thing is, as the price of gold continues to rise, there's a very high likelihood Agnico is going to take advantage of this and be able to grow earnings based off that earnings growth. It's the exact same thing as if oil went from $60 to $120 a barrel. You'd see oil companies trade at very, very high valuations, and their trailing price to earnings would look very high. When we look to forward PEG 0.2475, which pretty much suggests that the market is not pricing in a lot of future expected growth for Agnico moving forward. And when I go to that actual growth, when we look to earnings per share growth on an annual basis, this company is expected to post strong growth moving forward. We're looking at, they earned $2.88 last year. They're going to earn $5 a share this year, $5.03. When we fast forward to 2025, they're going to earn $5.54, which is around, double-digit earnings growth, which is relatively strong. And then when we fast forward to 2026, I would put absolutely no weight into 2026 earnings, especially in the gold sector. People have no idea where prices are going to be. People thought $2,600 an ounce gold was crazy just 3-4 years ago, and here we are sitting on it now. But overall, if you're looking to get exposure to the sector, I do believe Agnico is a outstanding option for those who want to maybe hold a producer over holding just the precious metal entirely, or maybe they want a producer over a streamer like Franco-Nevada. More risk, more reward, in my opinion. Look at the price as the price of gold has shot up. And I guess one of the main risks, obviously, there is still risk, mining risk. It's very, it's more volatile than a lot of sectors on the market. The mining sector is crazy. When gold prices are tough, these operators will struggle mightily. And again, if we see a falling price of gold, Agnico, no matter how well they're performing, is going to follow right down with it. So if you're looking for that, heightened risk but heightened reward in terms of a gold producer, I think Agnico is the best in the country. So the next stock we're going to go over on the list, and has been one of my favorites over the last few years, especially because this is arguably one of the most boring stocks you can imagine on the index that has absolutely crushed it, and that is Loblaw. They trade under the ticker L on the TSX, and why I love the stock, I believe it has the widest moat out of any Canadian grocer. So every single Canadian in Canada, on average, is 10 kilometers away from a Loblaw store. This is unmatched in terms of just convenience. It has so many stores. Its reach is so broad. It just is unmatched in that regard, even from other major players like Metro and like Empire. And I believe the company has the strongest discount presence out of any Canadian grocer. Now, Loblaw is a Canadian foundational stock over at Stocktrades Premium. So every single year we do a write-up on these stocks. And when I did my write-up in 2021, I said that this discount presence will prove to be absolutely vital moving forward. This is right when we started to see inflation creep up, and I said to myself, if food inflation continues to accelerate, people will not go to stores like Sobeys, which is operated by Metro. They're gonna head to a company like Loblaw because of that absolute discount presence they offer, rock bottom prices. When times get tight, when people start to pinch pennies, they're willing to shop around. Whereas during the COVID pandemic, when interest rates were practically, money was free, people might have went to Sobeys and paid a little extra for the little extra convenience, a little nicer store, maybe a little nicer produce, things like that. But when times get tight, people head to stores like Loblaw's, and there's absolutely no question we're seeing a absolute surge of activity in grocers like Loblaw's and wholesale grocery stores like Costco. They are skyrocketing in popularity because people cannot stand paying high prices, the ridiculously high prices for groceries right now. And, a lot of people have the misconception that now that inflation has settled, grocery prices are going to come down. Grocery prices are never coming down. If we see deflation in grocery prices over the long term, we can see short-term deflation in grocery prices, no doubt. But if we see long-term deflation in grocery prices, there's probably a little bit more of an issue, and your overall savings on grocery prices are probably going to be offset by a brutal economy, because overall, the objective for the Bank of Canada was to lower inflation down to a respectable level. In terms of 1.5-2% year annualized growth in food prices. It's not to get food prices down. They're not going down. So I believe this is going to be a permanent shift in the Canadian consumer to companies like Loblaws, to companies like Costco, to companies like Dollarama. And that is why we see companies like Empire struggling so bad. I mean, I used to shop exclusively at Sobeys. I never went anywhere else. Maybe a little bit to Costco, but now I don't know if I've stepped foot in a Sobeys store in over a year and a half. I shop at No Frills and I shop at Costco because they're so much cheaper. So this is ending up in the company growing earnings and same-store sales at some impressive levels. We're seeing, Empire Company, they're growing same-store sales at a 1% level. I think Metro's a little bit better, but Loblaw's is, they're talking about mid-single digit same-store sales growth despite, a huge run-up in activity over the last while. And, despite a huge run-up in price, I believe shares are still cheap. The company is buying back shares. They're tons of cash flow being generated. They're still buying back shares at these levels. And, there's a lot of boycotts. There's a lot, Loblaws, they do have a, bad reputation among Canadian consumers, but boycotts have tried and failed. The company's business, the discount business model is exceptionally sticky. We've seen it. I mean, you're boycotting the store due to high prices, but the fact of the matter is they have some of the lowest prices in the country, so shoppers are going to continue to go there. When times are tight, they're not going to make the sacrifice of going to pay higher levels in terms of grocery prices just to stick it to Loblaw. So excess cash flow generation will allow it to reinvest back into the business and expand infrastructure. It's doing this. It's dumping a ton of cash flow back into the business to get more energy efficient, which ultimately boosts margins, and buy back shares, grow the dividend, things like that. So when we look to Loblaw, this company has absolutely exploded in late 2023, right when policy rates, they were at their absolute peak. People were tired of paying high grocery prices. Loblaws has absolutely reaped those benefits, zero doubt. It's outperforming the S&P 500. It's outperforming the TSX over this time frame. When we fast forward to, or when we shrink it down to 5-year timelines, we're looking at 152%. When we look to the dividend, Loblaws, they weren't a very consistent dividend grower. Back in the financial crisis, Loblaws had some struggles, but they've really seemed to figure it out over the last while. The dividend, it's gone from, we're looking at, let's say the last time they doubled it, we would have been looking probably to 2016. So effectively, over the last 8 years, they've gone from 25 cents a quarter to 51.3 cents a quarter. So they've effectively doubled the dividend in 8 years. And I do believe that dividend growth is going to be maintained at a double-digit level. When we look to the overall quality of the company, we're looking at double-digit returns on invested capital. We're looking at 18% returns on equity. The one thing that many will not like about these grocers is low margins. I mean, we're looking at $60 billion in revenue and just $3.5 billion in free cash flow. And, we're looking at gross margins of 32% and operating margins of 6.19. Overall profit margins are even lower. They're at like the 3% range. This company, a lot of these grocers, they are all about volume. Ship out a ton of products, sell a ton of product, make very little. This is a very similar business model to Costco, which, by the way, has absolutely skyrocketed. It's a business model that works, sell a ton of volume, and overall reap the benefits from, lower margins, but way higher volume. Again, when we look to the dividend from a payout ratio basis, 27% of earnings and 16% of free cash flows. So this company is going to be able to raise the dividend at a double-digit pace moving forward. I would be absolutely shocked if they didn't. And even if they didn't, it probably would be for some reason that they felt the capital is better spent elsewhere. Infrastructure, new stores, things like that. When we go down to the balance sheet, we can see a debt to equity ratio of 0.81, very solid. Anything under 1 is generally, a good indicator that the company is not having to use a boatload of debt to finance the business. Instead, they're generating a lot of shareholder equity, which is generally more beneficial for you over the long term. We're looking at interest coverage ratios of 4.6. As I mentioned, I generally believe anything above 5 is relatively solid. And, the company has $1.35 in cash and cash equivalents per every dollar in liabilities it owes over the next year. So the balance sheet is very solid. Again, when we look to shares outstanding, as I mentioned, Loblaws is, they've gone from a share issuer leading up to, let's say, 2014 to a pretty aggressive, buyback. Like, it's bought back a ton of shares over the last 10 years. So you're looking looking at 411 million shares in 2015 down to 305. Now, the one thing about their share price and where this becomes so beneficial is when we looked at Loblaw's overall price, they effectively moved nowhere in price for, from 2015 to 2020. Meanwhile, they were scooping up shares at a crazy rate. This is a very good sign that management knows how to deploy capital properly. So we see all these buybacks. We're talking from 2015 from 411 million down to 338 million, when effectively the price didn't even move. And now we're seeing the price, it's gone from, they were buying back shares at 50, 60, high 40s, 50s, $60 a share. And now we're sitting, those buybacks, $175 a share. You can see how profitable those buybacks are. And the company continues to buy back shares even at these price levels, because realistically, if we look to valuations, the stock is really not all that expensive. I would call it fairly priced at this point. We're looking at 18.7x expected earnings. We're looking at, 15.7x trailing cash flows. And when you look to a 5-year historical average, this looks ridiculously expensive. It looks like the company's trading at, a 30-40% premium to its historical averages. But the thing is, there's been such a consumer shift that I do believe that the market is probably willing to pay a higher multiple for Loblaw's at this point in time, just because its growth rates are so much faster than that of Empire and Metro. I mean, when we look to actual valuations down here, we can see that Metro actually does trade at a higher price to free cash flow multiple, but Empire 8.36 times free cash flow. So effectively, the market is saying right now we value Loblaw's free cash flow generation at double the valuation of Empire Company. And again, that is that element of, Sobeys versus no frills. It's a crazy shift in consumer spending. So finally, last thing I'm going to talk about is the earnings estimates for this company. We can see that there is no plans for slowing growth, at least what analysts believe in terms of Loblaw's. We're looking at $7.60 last year. They're expected to earn $8.50 this year, $9.36 next year, and then break the $10 mark in 2026. This is a blue chip Canadian grocer that is expected to grow earnings at a mid double-digit pace. This is not typical out of these companies. I mean, usually, again, they're blue chip, dividend growers, mid single digit earnings growth on an annual basis. But again, the consumer shift in regards to Loblaw's is very real, and they are reaping the benefits. So everybody, hope you liked this video. It went on actually quite a while, but I do love talking about, the most popular stocks, the stocks I absolutely love, and these are certainly two of them. Head down below, like the video, subscribe to the channel if you liked it, and make sure to drop a comment and let me know what stock you want me to look at next. There is a subscription, or there is a link down below in the description to sign up for our newsletter. You would have got this article before we released it, before I'm talking about it today. So if you like this type of stuff, we send it out every single week along with, market commentary on, news, earnings, things like that I send out to members absolutely free. So sign up for that, and we'll see you next time for more great Canadian content.